US shares finished last trading week on a weaker note after some very strong gains over the previous trading days. In fact, the S&P 500 hit 5 new all-time highs over the previous 2 weeks before that slightly lower finish on Friday night. However, it wasn't all positive. Of those S&P 500 companies, 400 finished in the red on Friday night, and the gains and the fact that we saw the market hold up reasonably well on Friday night was once again largely due to a very narrow list of top stocks. Those mega cap stocks, the big tech stocks, and in particular Nvidia, were the main reasons why we didn't see a bigger sell-off in the S&P 500. And while the support for those big names continue, it would appear that the outlook for the US market remains positive, if rather narrowly focused. And one of the reasons for that strength can be seen in this chart. This is Nvidia. As you can see, over the last 3 months alone, Nvidia has made a 50% gain. Now, there was a bit of a shakeout as concerns about chips coming out of China rattled investor nerves, and so we are coming from a lower base. But nonetheless, despite the already spectacular gains in Nvidia, the last 3 months have just seen that momentum increase. And at this stage, it's very hard to see what might derail the momentum, in particular in these big cap stocks. However, there are other concerns for the market. We have seen US investors largely shrug off the increased tariffs that were announced last week and again over the weekend. And the reason for that appears to be a shift in market thinking. In April, we were concerned that the tariff barriers that were being erected and the threats of retaliation could likely lead to a decoupling of the world's two major economies, that is China and the US. That threat now seems to have diminished, and investors no longer seem to be connecting the imposition of new tariffs with existential threats to the market. Rather, they see them as a bit of sand in the gears of the global markets, something that might slow us down, but not something that's going to break the machine. And for that reason, we saw a more positive reaction. We also saw, instead of the sell-off in the US dollar that we saw in April, further gains for the US dollar on these announcements, once again illustrating the way the market has flipped in its thinking about the impact of tariffs. However, it hasn't stopped analysts drawing a straight line between tariffs and inflation. Inflation is likely to be the concern, and certainly was one of the reasons why investors were cautious on Friday night. We've got some important releases this week in the US on CPI and PPI, and also core inflation. And while the analysts will focus on the core inflation, it's the headline that's likely to drive investor responses, at least initially. Now, that headline rate is expected to increase on the month to 2.6%, up from 2.4%. And while that's still not far from the Fed's target point of 2%, the turnaround in the trend might give investors more reasons to think that we could be in a good position to look at some profit taking at least, because that turnaround in the trend in inflation is concerning. Now, if it's simply a blip that reflects the tariff impositions and perhaps higher energy costs due to that lift in the oil markets, however, if that trend continues and further inflation rates are expected to show further increases, that will rule out any further rate cuts from the Fed and might even see them go to a tightening bias. And of course, that would change the way share investors think about the future for interest rates. So something to be a little cautious about if that comes out of the inflation data that will be released Tuesday night for Asia Pacific investors. We've also got another factor feeding into market action, and that's that there are a number of official meetings in China at the moment, as well as a visit to China from the Australian PM. Now, of course, China is much more globally focused, but the issue that investors are focusing on is the potential for further stimulus in the Chinese economy to lift industrial production. And that's seen as not only a positive for the Chinese economy, but also for the globe, and in particular for commodity prices. And we've seen some surprise lifts in copper and iron ore markets, as well as further addition to the upward momentum in oil and gas markets. And that improved industrial outlook could feed into trading in the Australian share market today. CBA still near record levels, although having come off a little, and at a valuation that's over 300 billion Australian dollars, there are reasons why some analysts believe CBA has become too expensive. And that could see some investors selling out of CBA and buying into BHP. And here's the BHP chart. And as you can see, the share price is not near the highs that we saw earlier in the year and has been under pressure. And of course, that was largely due to the outlook for iron ore and copper prices. So with them turning around, there's potential for investors to be looking hard at BHP, whereas CBA, still near those record levels, could be vulnerable to profit taking, particularly given the potential to view this as trading at a very stretched valuation. So something to look out for in the Australian share market today, potential rotation out of CBA and other banks and into resource stocks like BHP. But banks are also likely to be on the radar for international investors, with reports coming out of the US from 6 major banks this week. And of course, the quarterly earnings report for banks not only speak to the health of their share prices, but the health of the broader US economy. So a very good litmus test for the market. There are, of course, plenty of other earnings reports to come out, and investors should use the earnings calendar to make sure that their stocks, when their stocks might be reporting, one of the highlights for me this week will be the world's largest fund manager, BlackRock. So looking forward to a busy trading week. We also have employment data here on Thursday in Australia. So plenty on the market calendar in terms of earnings and data to drive trading this week.